DeFi in the sense that we're all familiar with it is dead. DeFi being dead is not necessarily a bad thing for those of us who are in DeFi. Most capital markets transactions 10 years from now are going to settle on a blockchain. We're not talking about $10,000 loans, we're talking about a minimum of 10 million. Maple did its largest loan just before Christmas 2025, which was 500 million. I look at the traditional players of Apollo, Ares, KKR, Blackstone, Blue Owl, and these guys have had fantastic runs of growth over the last 30 years. But I look and I think we have an opportunity to catch up and indeed overtake them to be the largest in that space by leveraging this new technology.
Lending is one of the products that has found significant product market fit in DeFi and is growing at a rapid clip. And there are different types of lending protocols in DeFi. You have the Aves, and then you have the very institutionally focused Maple Finance, who are managing more than $4 billion in TVL. We have Sid Powell, co-founder of Maple Finance, on Alpha Unashed.
Sid Powell, welcome to Alpha Unashed.
Thanks for having me, Sri. Glad to be here.
Sid, you said DeFi is dead. Is DeFi dead?
I think DeFi in the sense that we were all familiar with it is dead. So I think now DeFi is moving away from being this kind of counterculture or niche area to merging with FinTech and Web 2.0 finance. And so I think that's the sense that DeFi is dead, in that now it's less about catering to a kind of insular small community, and it's more about, can you produce products that customers want to use, that produce revenues, and that are actually making a dent and seeing adoption in Web 2 FinTech and traditional finance. And so I think DeFi is dead. DeFi being dead is not necessarily a bad thing for those of us who are in DeFi.
Yes, no, I understand the spirit of it. In fact, as we were just reflecting, we met up at DAS in New York a couple of weeks back, and it's amazing how digital crypto DeFi has become digital assets, and the whole transition into being a more organized, institutionalized, regulated ecosystem more. And I think both of us also took out our jackets and suits for DAS. So it's so it is very reflective of exactly what you're saying. I mean, DeFi is, yeah, go ahead.
We did. I was just going to make the point, in 2022, DeFi was yam coins and yield farming. Now, when people talk about DeFi, they're talking about giving access to huge neobanks, whether it's a Revolut or a Robinhood or a Nubank, so that, millions of customers can now access yield from across the globe. So we have come a long way since 2022.
Yeah, absolutely. Yeah. So let's dive into Maple, clearly an OG in the space, and we will go through your sort of tumultuous journey, and it has just been a phenomenal ride. Before that, if you could just kind of lay out for everybody what exactly is the meaning of institutional credit in DeFi, and how is Maple specifically designed for institutional credit markets, and how it's different from, let's say, Aave and Morpho. So there are a couple of things. If you can just take your time and just dive into that. Starting with, what is really institutional credit in DeFi?
Yeah, there's kind of three key parts to that. So when I think of institutional credit in DeFi, I think large loan ticket sizes. I think corporate and institutional borrowers, whether these are exchanges, prime brokers, large asset managers. But here, we're not talking about $10,000 loans. We're talking about a minimum of 10 million. And Maple did its largest loan just before Christmas 2025, which was 500 million. So we're talking larger transaction sizes. And what we've tried to do with institutional credit and lending in DeFi is find a way to make this type of product, so loans and borrowing, accessible to institutions who have thus far been too risk averse or had other issues with DeFi and have not wanted to interact with smart contracts. So Maple's product is therefore tailored to this kind of audience. So they don't have to put collateral into a smart contract. They don't have to wrap their Bitcoin. They don't, they don't risk a full liquidation if the price of Bitcoin drops. It is a more higher touch process that reflects the type of service that they're used to getting from CeFi and TradFi counterparties. When they hit margin call, they get a margin call notification from us. They get 24 hours to post, and they can place their collateral in qualified tri-party custody. So it's a tailored product that invites these large institutional players to interact more and more with DeFi. And DeFi benefits by getting curated yield opportunities and sustainable yield that is not coming from things like looping and kind of points farming. It's coming from real commercial activity and real credible borrowers.
Right. And these large institutions are already digital asset native institutions. They're already holding collateral in the form of the obvious big ticket ones are Bitcoin, Ethereum, or are they also not very digital crypto native institutions as well who are really looking at on-chain borrowing?
Well, Sri, I wish I could say it was the latter and that we have more non-digital native institutions coming. Thus far, it has, the truth is that it has been mostly digital asset institutions. So it's exchanges, it's asset managers, it's prime brokers who are all familiar with, with Bitcoin and ETH and Solana and XRP and who use stablecoins in their business. What we're seeing, though, is that 2026, this is starting to change for the first time. So now most of Maple's business, most of the 20 billion in loans we've done since inception have been to digital asset native companies. But this year, Maple is looking more and more at FinTech, asset-backed lending. So cards programs, smaller medium business lenders, invoice finance lenders. But we're looking at FinTech originators who up until now have never really had anything to do with stablecoins or the blockchain. And they're now increasingly interested in engaging with stablecoins so that they can ensure that they're not getting left behind as the technology advances. And so I think, this year, Maple will do its first FinTech asset-backed loan. We're evaluating several opportunities at the moment, but this really marks a watershed moment where we're starting to see firms who are not crypto native now come in and engage with lenders like ourselves. And I think that trend is only going to accelerate over time because right now the market for Bitcoin-backed lending is just much smaller than the market for FinTech asset-backed lending or, asset-backed securitisations. And so if we in the space want to deploy more capital, we're going to have to start to bridge across to TradFi and to Web2 fintechs.
All right, now that's very interesting, and that's exactly the sort of direction that we're talking about. The whole convergence of DeFi with TradFi, it will be in such a form that DeFi will not exist, as we know it, as we sort of known it for some time. Now, when you say fintech asset, so what exactly are we talking about? We're looking at tokenized form of financial market assets like equities and bonds and stuff like that, or what?
I have spoken to firms who are tokenizing equities, and Maple would consider lending against those. Tokenized NVIDIA has a market cap comparable to Bitcoin. So if we're happy lending against Bitcoin, we should be happy lending against NVIDIA. But what I mean when I talk about fintech asset-backed lending, I mean card issuers. So they issue credit cards or debit cards. There are receivables. They can sell those into an SPV, and this is very similar to what I used to do in securitization banking when I was in TradFi. But so in that case, Maple would fund a senior position to an SPV that holds the rights to, say, card receivables. And that would be a fintech company who issues cards where you can say spend stablecoins or spend against crypto, or it's credit cards for consumers. But the key is it's got to be asset backed. We've got to be in a senior position, and it's got to be a duration less than 12 months. So we're not looking to go out and do 5-year loans at this stage. We don't want to do unsecured lending, and we want to minimize any counterparty risk. So currently, I think the interesting part is this is where crypto is now starting to compete with some of the big private credit funds or big credit funds and traditional lenders. So this is one of the first times we're now seeing crypto make inroads outside of where it is traditionally played into a market that's more been dominated by traditional lenders. And we're able to do that because currently there's a low cost of capital. You can see it in the on-chain yields. They've been very low, but that means that we're now more competitive with traditional finance. And because of the large amount of idle stablecoins that have been situated on chain. So it now means, you can now go out as a crypto lender and quote a facility that's 100 or 200 million in size. And so this is where, for the first time, we're able to be on the offensive and start to look at eating some of TradFi's market share. So I think it's a very exciting time.
Mm-hmm. And you mentioned private credit specifically. So can you draw the parallels of how DeFi private credit on say Maple would compare to existing TradFi private credit going into corporations?
Yeah, it's a subject you've got to tread carefully around because private credit in traditional finance is not having a good moment. But if you counted, if you defined private credit as any form of bilateral lending that takes place out of public bond issuance and outside of the banking system, then it's very broad. Technically, even collateralized Bitcoin-backed lending is a form of private credit. So I think it's very important to designate where are the risks at the moment in private credit, and it tends to be more focused around large software loans to software companies. This is the subsector that everybody is talking about at the moment, and where most of the concern lies. So when I talk about private credit as it applies to crypto lenders, I'm talking about both the Bitcoin-backed lending that we've specialized in to date, but I'm also talking about asset-backed lending. So where you fund an SPV in a senior position and the SPV owns the rights to cash flows, whether it's 1,000 home loans or 10,000 credit card accounts or 500 auto loans. That area is very mature. It's what I used to do when I was in banking in securitization, and this is much lower risk than the 12% private credit loans to software companies. So I think it's important to differentiate that so that people don't hear me talk about private credit and think we're trying to wade into this risky area. No, we want to be very firmly in investment grade stuff, lower risk, asset-backed senior positions, and it's important to note that's a space that has been dominated by private credit funds and banks for the last 20 years.
Right. Yes, private credit is like this catch-all term, and it just
it's huge. It's $3 trillion market, but there's a lot of different subsectors in that $3 trillion.
No, absolutely. I think the same conversation I was having with someone else regarding the private credit market in India, which has high yields, not because of the risk profile, but because of the dearth of capital for servicing, real genuine, mid-sized corporates looking for credit to grow. So that growth capital, because of sort of multiple restrictions, there is whole supply-demand gap, and that sort of private credit, it becomes when you look at tokenizing that, for example, and when that becomes itself a collateral. So there's so much that can be done. So there is a specific issue with private credit with software companies in the US, specifically, probably, but there's a whole bunch of private credit which is really sort of cash flow generating at very healthy space in parallel to promote capital. You got obviously a deep background in credit markets and in securitization, and bringing that whole experience and expertise to DeFi, and started Maple back in 2019, and it went through some pretty tumultuous times as well, and then but you kind of gone through all that. Share a bit of that journey about how this has all been. What's been your most important learnings through this whole last 6 7 years?
There's a lot to unpack there. So my co-founder Joe and I started Maple back in 2019, and this was while working in traditional finance. We initially kind of got into the space really more via smart contracts rather than, say, owning or investing into Bitcoin or other ICOs at that stage. So we're fascinated by the idea of using smart contracts to program bonds and program securitisations the way that I've been doing in traditional finance. So I think the important thing to note was one lesson was you can start out with any plan, but no plan survives first contact with the enemy. And so our initial idea was tokenizing bonds, but there were no bonds that we could tokenize then in crypto, and there were no investors on chain for that type of thing. So we had to pivot and adjust the business model to do more direct lending, and so that was one of the first changes of direction that we made with Maple, and then you have to find a product that you can actually sell to the market as well. So I would say when we first started, the over-collateralized lending space was very saturated and heavily competitive. So we couldn't get a foothold there. So we started with uncollateralized lending and being infrastructure. And then we went through a tumultuous period in 2022. And really the lessons of that that we took away was, one, we wanted to be more vertically integrated. We had positioned ourselves in 2021 to be infrastructure, and in infrastructure, you only get so much control over the product. And I think we have since looked at companies like Apple and Tesla and SpaceX and others that have been very successful, and they tend to have a much larger degree of vertical integration. It's very hard to be very big and very successful as infrastructure. You just lose too much of the margin of the product. So vertical integration was a huge lesson for us, and we've been doing that since 2023, where Maple now, we curate the vaults that we have on our platform, we write the infrastructure and the smart contracts, and so we are much more vertically integrated than we were. And I think the other thing is that I've learned over time that there's no real technology moat. All you can do is kind of try and execute faster than your competitors. And so if you look, we were initially uncollateralized lending, then we've been over collateralized lending. Now that space is again getting saturated, we are looking at doing things like FinTech, FinTech origination, and trying to expand the pie again and stay ahead of our competition. So I know that was kind of a long-winded answer, but it's some of the lessons we've learned. So vertical integration, you have to find a product that people will buy. I see a lot of teams kind of push technology into the market where there's not a willing buyer, and those teams end up finding that they are 3 or 4 years too early, and they kind of languish without making any real traction. And then the third element, as I mentioned, was there's no inherent technology moat. You can't rest on your laurels when you have a large footprint in the space. You have to stay ahead of your competition, and you have to do that by being just more agile, adding more product features, and in our case, it's expanding the yield opportunities that we can deploy into.
And you've been very agile, as lending sort of it's been one of the biggest vectors within DeFi, which has found real power market fit at scale. You guys have been at the forefront of that. As stablecoins have kind of been really the rails driving everything in DeFi in many ways now. You also have the Syrup. Is it the MUSD or the SyrupUSD?
Yeah, we have SyrupUSDC and SyrupUSDT at the moment. So those have, I mean, those two products are each now over $1 billion. So we have $2 billion plus assets in DeFi. They generate yield. These are not stablecoin products themselves, but they are yield products built on top of stablecoins, so built on top of USDC and USDT, where the yield comes from the lending activity that we do to institutional borrowers.
All right. So that's, would that be the prime source of the supply side for your capital?
Yes. Yeah. Very good question. So for the listeners at home, the way I think of supply side is the capital that comes into Maple, and the way I think of the demand side is the borrowers who take out loans. Now, anyone, there's no special source into. You can think of it in the opposite, and some people do, but that's how we think of it. We think of supply of capital and demand for loans. And SyrupUSDC and SyrupUSDT have been the biggest draw cards for supply for us. And I think one of the key reasons is that they are composable through DeFi. What does that actually mean? Well, it means you can mint SyrupUSDC or SyrupUSDT, take that receipt token that's generating a yield, put it onto Aave or Morpho or Euler, so you put it onto a borrow market as collateral, and then you can borrow against it at a lower interest rate, loop it, and generate a higher yield. So we've seen that has been very popular among asset managers in DeFi. You've also been able to fix the interest rate using markets like Pendle. So I think that composability is something that TradFi lacks, and they're conscious of, and you can see it. Why are all these asset managers coming in now talking about issuing vaults? It's because they want these composable tokens as a way to distribute their products.
The entire yield that is generated is from your native lending, or do you also deploy to other protocols?
Sometimes we deploy to other protocols. So we have a pretty conservative risk appetite, but when we have idle cash, so certainly our first preference is to deploy to crypto-backed loans. If we have any available in the pipeline, we will do that first. But then often we're left with idle capital. This is a good problem to have. It means we're taking in a lot of deposits because our yields are very competitive for lenders. But what we do there is we will either use like money market protocols. So think Sky, we've used Aave. We have them integrated with bots, so it goes in automatically. And Superstate's tokenized T-bill products. So we also use T-bills as well for short-term yields. So it's broadly, those deployments will be short-term while we are waiting to originate new institutional loans, which is our first preference.
So you obviously have a very sort of a bespoke hybrid approach to DeFi. It's all permissionless on public open chains. The protocol itself is deployed across all major chains. But at the same time, you've got institutions where your teams are actually in touch with. There is some amount of institutional credit verification that's also done. And at the same time, as you mentioned, there isn't, the main part for institutions is that they don't get liquidated when there are sort of drawdowns or spikes that are happening all of a sudden. That's when your teams actually reach out, and they've got the opportunity to add more collateral or reduce their exposure. So this must be pretty intensive in it's kind of this whole hybrid DeFi and conventional credit market kind of approach. How do you manage it? How large is the team? What are sort of broad risk frameworks that you use? I mean, it's so new, so trying to understand how you evolved this whole practice in many ways.
Yeah, our practices have definitely evolved over time. For one thing to clarify and elaborate on, so for all borrowers, so we do KYC of every borrower, and then we will look at their financials, and then they sign loan agreements with us. And the reason for this is because they're going to put collateral in a custodian, so they have to be onboarded with the custodian. We have to ensure that they are going to be able to post more collateral, because our business model, it's not good for us. We don't make fees when we liquidate people, so we therefore don't really want to liquidate people. We just make money when our borrowers are paying their interest. And so our loans are all recourse. So even if there were a shortfall in the collateral value, we would still be able to go after the other assets of the borrower. And so that is also another reason that we need to KYC them, know that we have a valid legal agreement in place with them. How we manage the risk. So we have two levels. So we have the margin call level. At that stage where our product is sending out automated notifications to them, hey, you need to either post more Bitcoin or pay down your loan. Our team is reaching out at that stage as well, and the borrower has 24 hours to post. If they don't, over that 24 hours, then we start to liquidate the collateral. But the difference between us and, say, an Aave or a DeFi protocol is that the DeFi protocol has to liquidate all of the collateral because they don't know if you're going to pay it back. Whereas we are in touch with our borrowers. So we give them the benefit of just liquidating back to the initial loan to value ratio. So you don't lose all of your collateral. And that's been a big selling point for institutional borrowers. And we don't charge them a penalty. So that's the other thing, is that DeFi protocols, they tend to make most of their money when they liquidate borrowers. So they give you a low interest rate, yes, but if you happen to get liquidated, you're getting a bad deal. And so that's the trade-off for DeFi borrowers. For us, as you pointed out, Sri, some of this is quite intensive. So we have around 41 people on the team today. This still, I would argue, is quite lean. So in 2022, we got to about 40 people as well, but we were only managing $1 billion of assets. Now we have about I think it was yesterday, it was about 4.2 billion. It's been as high as 5 billion in assets and TVL on the platform. So we manage about 4 to 5 times as much, but we have roughly the same amount of people as we did in 2022. And that's because we've been able to automate a lot more this time around and leverage tools like AI to be much more efficient. But our team's spread out across the US, so North America, as far east as Dubai, with a number of folks in Europe. And but we try and keep to those 2 time zones. So we found that if you go any further, it gets very hard to kind of coordinate meetings where everyone can attend, and that means that you end up with communication issues across the team.
Okay. Well, that's fascinating. In terms of the risk management, you've got this 24-hour window. How do you handle edge cases? For example, if market still continues to tank heavily through that period, and your client hasn't deposited more collateral, so you're still sticking to that 24-hour window because you have sort of second charge through your legal documents. You have recourse to other collateral. Is that how you look at it, or you have other mechanisms in place? Let's say if there is further drawdowns, then you will liquidate collateral.
Yeah, no, we try and stick with the deadlines in the contract. It's an institutional business, so it is still relationship driven. But what we found is that in 99% of our margin call cases, the borrower posts within 2 to 3 hours. That's because typically we're lending to institutional counterparties who have a 24/7 trading desk. So they can post you more Bitcoin at 2 a.m. on a Sunday if they need to. So they're used to that 24/7 coverage. As we're now starting to deal with more public companies and traditional companies who might look at borrowing, they start to orient more of their operations around business days. So we're having to look at how we can accommodate that, so that we're managing their risk, but we're in line with their operating cadence, which is more Monday to Friday. So that's been a little bit of an adjustment that we're looking at the moment. But by and large, I think it's very important that, we try and adhere to the frameworks we put in place. That's what allows us to take on more capital. That's what gives lenders more confidence in our processes and track record, is that we're not making exceptions every time somebody gets margin called. We had one in February, and we couldn't get a line of sight on when the borrower was going to post more collateral, so unfortunately we had to liquidate them. Now, it wasn't good for them. We didn't like doing it, but that adherence to the process, our standard operating procedures, is what gives larger counterparties and allocators the comfort that they can put their funds with us. So unfortunately, we just have to do what's good for the long-term health of the business and for our lenders in that case.
So what's the sort of broader, larger vision for Maple?
So right now our initial wedge has been crypto-backed lending, and longer term we hold the thesis that all capital markets are going to transact in stablecoins, everything's going to be tokenized, and most capital markets transactions 10 years from now are going to settle on a blockchain. So we are trying to position ourselves accordingly to become one of the largest alternative lenders, alternative asset managers. So I look at the traditional players of Apollo, Ares, KKR, Blackstone, Blue Owl, and these guys have had fantastic runs of growth over the last 30 years. But I look and I think we have an opportunity to catch up and indeed overtake them to be the largest in that space by leveraging this new technology. We are stablecoin native, we are crypto native. And so I think we're going to be able to ride that wave of blockchain adoption as it eats the financial system, and in a way that they are just not able to, because their entire operational history for 30 years has been oriented around using the banking system. 10 till 4 or 9 till 5 Monday to Friday financial markets. And so I think we can get an edge to get ahead of them, the same way that Amazon was able to get ahead of Walmart, just by same or similar business model, but different technology stack. And our initial wedge is crypto-backed lending. Then it will be other forms of origination like FinTech, asset-backed lending, loans against tokenized equities. But over time, we will continue to expand that wedge, go into markets that look pretty small and unattractive to them, but those markets will grow over time and we'll catch up and overtake them. We want to be in that number one spot.
And just looking ahead, doing some crystal gazing, what do you think is the time horizon for let's say Maple to be accepting any kind of tokenized asset? Of course, not any kind. I'm just using the term broadly, but tokenized assets from multiple jurisdictions, from multiple markets, for example, as collateral and lending sort of seamless fashion against that collateral.
Well, I think you could see it before the end of 2027. It's obviously going to be limited. You're not going to have 10 markets in 2027, but you might have 3 or 4. You might lend against tokenized UK equities or tokenized UK funds and tokenized European funds or equities, or tokenized Singaporean funds or equities by then. So I could see you having maybe 3 to 5 markets by early 2028 or by the end of 2027. So I don't think that's that far off. We're already I'm getting pitched loans against tokenized Nvidia or tokenized Mag 7 stocks. I think that's pretty interesting. They all have comparable market caps to Bitcoin, so I don't view it as any riskier than lending against Bitcoin. And then you have tokenized funds. So you've already seen some lending happen against tokenized funds. So I think it's only a matter of time before you have it against a wider set of tokenized assets, and in different markets and jurisdictions. I've received, just over the last 2 weeks, I've had pitches for tokenized allocations from Hong Kong, Singapore, London, Dubai. So it is very much, the space is already heavily globalized.
In terms of your broader asset management play, beyond lending, are there other areas that you will look at in the next 3 to 5 years?
I think you have to kind of recognize your circle of competence. So A16Z, Citadel, and Apollo or Ares are all asset managers. However, they do very different things. A16Z does venture, Apollo does credit and lending, and Citadel does high frequency trading and multi-strategy macro asset management. So there are other products we can offer. I think it's good to offer some other products where they are they're either complementary to what we already do, or they kind of fall within an area that we already have, a competency in, a high degree of competency. So my preference at this stage is we do crypto-backed lending. We can look at FinTech lending, maybe, asset-backed securities. So things, various forms of asset-backed loans. We have crypto asset-backed loans, we have private asset-backed loans, and then we would have public asset-backed lending. So those are the areas that we're looking at the moment, lending against equities. I prefer to keep our circle of competence to credit at the moment. I don't think we are going to be good venture investors. I don't think we are good at making macro calls. So I think for the moment we'll stick to the lending circle of competence and just try and expand what we do within that space. Don't expect us to see us doing venture bets anytime soon.
Great. And what's your prediction for, let's call it the new DeFi as opposed to the dead DeFi? What's your prediction for the new DeFi in terms of the TVL that it will scale, especially with the rapid growth of tokenization as we're looking at, especially the growth of lending markets as we look at. Let's take a 1.5 year from now and a 3-year horizon. What's your take on the TVL that we will be seeing?
Well, I think the growth areas that we're seeing in DeFi at the moment, each of them has the potential to disrupt traditional finance. And what I hear, the growth areas I hear most about at the moment are stablecoins and lending. The two are kind of linked because you lend stablecoins. The other ones are prediction markets and perps. So each of these is an innovation. So stablecoin loans that can settle 24/7 and on weekends globally is a massive innovation that's much better than what you get in TradFi. Prediction markets, also much better than what you can get in traditional finance. You can now bet on political events, hedge real world events. I don't need to mention that's become immensely popular. But what has been interesting is that I've been hearing from traditional players that they are looking at launching their own prediction markets now. So I think, you've seen ICE invested in Polymarket. They are concerned that trading will migrate from their traditional venues to prediction markets. So I think that's been a huge innovation that's been pioneered within crypto. And then the third one is perps. So perpetual swaps were invented by crypto, by BitMEX. And then now they've become so popular that you see hyperliquid trades oil futures on the weekend because it's the only place that you can trade commodities on the weekend. And so traditional finance is also going to adopt perps, like perpetual swaps, over time. So I think when we talk about new DeFi, Sri, I think those three areas, so stablecoins and lending, perps, prediction markets, are going to push out into TradFi, and they're going to attract billions of dollars that comes in from traditional finance into this space. And that's going to be the fault line where traditional finance meets DeFi, and the two start to merge over time. Already, when it comes to some of the partnerships for lending and stablecoin yield, where we're talking with Web 2 companies or neobanks or fintechs, the dollar terms that you're talking for each of those relationships is multiple billions of dollars. So I think, just based on those numbers alone, it will dwarf, what was old DeFi.
This has been a fascinating conversation, and seeing the phenomenal growth that he engineered and steered people towards, and the whole pathway. Rooting for that as we look at the new DeFi and really gain traction. Sid, awesome having you on Ash. Thank you.
Thanks for having me, Sri. My pleasure.